Greetings traders, welcome back to our weekly market analysis at Trust Markets, where we will delve into essential data that could significantly impact the forex market and other financial instruments. Let's jump right in. First on the agenda is the much-awaited Fed interest rate decision from the FOMC. In the previous meeting, FOMC participants chose to maintain the current Fed funds rate, allowing more time for assessing the economy's progress, with inflation still above the 2% target and a tight labor market. The majority of officials are contemplating raising borrowing costs later this year. Should the Fed decide on a 25 basis points rate increase, it might potentially strengthen the US dollar, as higher interest rates often attract more foreign investments. Consequently, this could exert downward pressure on US indices, especially those with significant exposure to international markets, as a stronger dollar can impact exports and company earnings. Now let's shift our focus to commodities. A rate hike could weigh on gold and silver prices given their typical inverse relationship with the dollar. As the dollar gains strength, commodities priced in dollars become more expensive for foreign investors, leading to potentially lower demand and dip in their price. Moving on to euro area, we have news about their interest rates. In the previous meeting, the European Central Bank raised rates by 25 basis points due to concerns about persistently high inflation. Looking ahead, there is speculation that they might consider an even more substantial 50 basis point increase after July. An increase in euro area interest rates could potentially strengthen the euro, as higher rates often attract foreign capital seeking better returns. Now let's discuss the United States durable good orders MOM. While May 2023 saw a 1.80% increase from the previous month, there is an expectation of a minus 0.8% decrease this month. A decline in durable goods orders might raise concerns about economic growth, potentially putting downward pressure on the US dollar. However, the impact on the stock market can vary. If the decline is limited to specific sectors, we might witness selective adjustments in the stock markets. Now we have the US GDP growth rate QoQ2. In Q1 2023, the US economy surpassed expectations, expecting by an analyzed 2%. However, the anticipated growth rate for this quarter is minus 0.10%. A negative GDP growth rate could weaken the US dollar, as it might signal economic contraction. US indices might face a sell-off as investors adopt a more cautious approach towards the economic outlook. Nevertheless, bear in mind that other factors can also influence market sentiment. For gold and silver, a negative GDP growth rate could strengthen their safe haven appeal, potentially driving up demand and prices. Lastly, let's look at the US Core PCE Price Index MOM. The Core PCE Price Index is a measure of inflation, and an increase in this index could heighten expectations of higher interest rates from the Fed. If the Fed does indeed raise rates, it might boost the US dollar as investors seek high returns in dollar-denominated assets. Thank you for watching and see you in the next video.